Good afternoon, everyone. Thank you for being here today, and welcome to our first webinar on our recently launched range of IncomeShares ETPs. My name is Oktay Kavrek, and I am the head of strategy here at Leverage Shares. And before we dive into the main part of today's presentation, I just want to take a few moments to basically introduce Leverage Shares as a company and what we've been working on the past few years. So, launched in 2018, we are Europe's leading issuer of single stock exchange traded products. So, to date, we have over 160 exchange traded products across 4 exchanges, which includes London, Italy, Germany, and also Amsterdam. We have now over 1 billion in assets, and our product range has expanded to covering everything from short and leveraged to commodities to a white label offering, and now income. The IncomeShares brand is part of our broader strategy to essentially offer professional grade tools that's packaged into a convenient to trade ETP. AUM in these types of US listed options ETFs have grown over 600% just in the past 3 years. And it was the ETF wrapper that played a crucial role in basically bringing about that widespread adoption. So what we're trying to do is bring that same access to option strategies for investors on this side of the pond. These are Europe's first range of covered call ETPs on popular stocks, and also the first range of zero DTE options ETPs that are tied to popular indices. And I think what you'll see is that some of the best parts of these is the fact that they're domiciled in Ireland, meaning that there might be some withholding advantages for non-US investors. So I just want to move forward in the presentation. Just a few very exciting disclosures that I will leave for later that you can come back to and read over. And with that, I want to introduce my colleague and our senior researcher, Violeta Todorova. She will guide you through the specifics of the IncomeShares ETPs, essentially what they are, how they work, and why they might be a good addition to your portfolio. So without further ado, please welcome Violeta Todorova.
Good afternoon, everyone, and welcome to our webinar on IncomeShares ETPs. I'm Violeta Todorova, and I'm excited to have you all here today as we dive into how these innovative products can diversify your investment portfolio and enhance your returns by generating consistent income while managing risks effectively. In today's volatile markets, investors are consistently seeking strategies that offer a balance between growth, income, and protection. That's where IncomeShares ETPs come in. These exchange-traded products are designed to create a strategy stream of income by using the covered call and zero DTE put option strategies, well-established techniques that many investors use to generate additional returns on their holdings. In this session, we will introduce the essentials of options and break down how the covered call and zero DTE put option strategies work, when they're most effective, and what kind of outcomes they offer in different market conditions. We will also examine the trade-off between growth and income that these strategies typically involve. As the population ages and inflation continues to push the cost of living higher, the need for reliable cash flow from investments has become more important than ever. While there are various ways to generate income from investments, many investors are seeking alternatives that offer better results than traditional fixed income products. One strategy gaining huge popularity in recent years is the covered call. By the end of our session, you will have a solid understanding of how and why the IncomeShares ETPs can fit into your investment strategy and why it provides a cushion against potential downturns while generating a regular income. You will understand the limitations of traditional fixed income and why a growing number of investors looking for income is migrating towards covered call ETPs. We encourage you to ask questions and engage with us throughout the presentation, as our goal is to ensure you leave with a comprehensive understanding of the products and how they can benefit your portfolio. But before we get started, let's address who might these products be useful for. When investing money, investors are faced with many choices. The two common investment strategies are growth and income. When choosing between growth and income, we must consider our risk and return profiles and our investment goals. Growth investing is an investment style focused on increasing the original investment. On the other hand, income investments are focused on paying out dividends to investors based on a set schedule. Income funds generate regular income, which also helps to lower the overall portfolio risk, offering a unique blend of cash flow, stability, and growth potential. In general, income funds have relatively high yields and can be a reliable source of income. They tend to be less volatile than funds focused on growth stocks. The trade-off is that during bull markets, income funds may underperform growth-oriented funds, but on the flip side, income funds tend to outperform during bear markets. So overall, investors buy income funds because they seek dividends and portfolio diversification. If your main goal is high total return, our leverage shares ETPs are more suitable for you. But if you're looking for diversification and your main goal is enhanced regular monthly distributions, then IncomeShares ETPs are the right choice for you. Thank you again for joining us today, and let's get started with the essence of our presentation. So let's begin our webinar with an introduction to options. An option is a financial derivative contract between two parties in which one party, the buyer, has the right but not the obligation to buy or sell a specified underlying asset at a predetermined price on or before a specified expiration day from the other party called the seller. The seller of the option has an obligation to fulfill the transaction if the buyer exercises its right. A key characteristic of options is that the buyer is not obliged to exercise the trade and will only do so if changes in the price of the underlying makes the option profitable. This mechanism provides the buyer with protection against adverse market movements in the underlying, while enabling them to profit from favorable ones. The risk of loss is carried by the seller, who charges the buyer a fee for taking on that risk. This fee is called a premium. This feature of an option contract differentiates it from other derivative instruments such as futures, where both parties on the contract have an obligation to complete the transaction at a future date, regardless of market conditions. In an options contract, only the seller has an obligation to transact, but this obligation is contingent upon the buyer's decision to exercise their rights under the contract. The act of enforcing the buyer's right under an option contract is termed exercising the option. Options generally have 5 key elements: type of an option, underlying asset, strike price, expiry date, and premium. There are 2 basic types of options: calls and puts. A call option gives the option buyer the right to buy a specified asset at a specified price during a specified period. Upon exercise of that right, the option seller is obliged to sell the underlying asset to the option buyer. A put option gives the option buyer the right to sell a specified asset at a specified price during a specified period. Upon exercise of that right, the option seller is obliged to buy the underlying asset from the option buyer. An option contract must relate to a clearly identifiable asset, for instance, a specific stock, index, commodity, a particular futures contract, a debt instrument, or foreign currency. This identifiable asset is known as the underlying asset. An option has a strike price or exercise price, which is the agreed price at which the underlying asset will change hands if the option is exercised. If the price for which the underlying asset can be bought in the case of a call option or sold in the case of a put option, if the buyer of the option elects to exercise its right. At the time of deciding whether or not to exercise an option, the buyer will exercise it only if it is profitable to do so, meaning if the strike price is more favorable than the current price of the underlying. Such an option is described as in the money. A call option is in the money if the price of the underlying asset is higher than the strike price, while a put option is in the money if the price of the underlying is lower than the strike price. If exercising the option would result in a loss, the option is said to be out of the money. A call option is out of the money if the underlying price is lower than the strike price. A put option is out of the money if the underlying price is higher than the strike price. An option is at the money if the underlying price is the same as the strike. This applies to both call and put options. The expiry date of the option, also known as maturity date, exercise date, or declaration date, is the last day of which the option may be exercised. In this context, there are two different types of option styles. An option can either be an American or European style. American style options can be exercised by the buyer at any time from the date of purchase up until and including expiry date. European style options can be exercised by the buyer only on the specified expiry date. The last element of an option is the premium. The premium is the cost of price of the option. It is the amount paid by the buyer to the seller. And now that we have briefly covered what options are, let's move on and explore in more details what IncomeShares ETPs are and how they perform in different market conditions. The IncomeShares options ETPs are designed to generate monthly income for investors by using a covered call, also known as buy and write option strategy. A covered call position is created by using shares, an index or commodity, and selling the same amount of American style at the money or up to 5% out of the money call options on the same underlying, which have 1 week to expiry and are rolled over on a weekly basis. In return for the sale of the call options, the fund receives a premium. From the weekly premium received from selling the call options, the ETPs pay a monthly yield to investors. The strategy allows the fund to retain upside exposure to the underlying price up to the option strike price, in addition to any dividends, if any at all. It should be noted that the fund strategy will cap its potential gains if the underlying instrument substantially increases in value. At the same time, the fund strategy is subject to all potential losses if the underlying decreases in value, which may not be fully offset by income received by the fund. The covered call is one of the most popular strategies among investors, enabling the option sellers to generate additional income from their portfolios. A covered call is also considered a type of hedging strategy where the investor sacrifices some of the potential upside of the underlying for a certain period in exchange for the option premium. The strategy also provides a downside protection against potential future declines in the price of the underlying. Let's now dive deeper into the covered call and discuss what the strategy is, when it's best to use, how to set it up, and how to exit it. A covered call option strategy is designed to generate additional income. As we said earlier, the strategy involves holding a long position in a financial instrument while simultaneously selling call options on the same asset. The primary objective is to earn premium from the sale of the call options, which can provide a buffer against potential future declines in the underlying asset price. The potential losses are limited to the downside movement in the underlying asset's price, less the premium received from writing the call option. The strategy is considered covered because the option seller already owns the underlying asset, mitigating the risk of having to purchase the asset at a higher market price to fulfill its obligation if the call option is exercised. Generally, covered call strategy is ideal for investors who are neutral to moderately bullish on a certain asset and are intending to hold it for an extended period of time. Writing calls over these assets helps investors generate additional income and lowers the cost basis of the original position. A covered call is relatively easy position to establish. Firstly, the investor needs to select an underlying asset to buy, which is willing to hold for the duration of the options contract or longer. Once the underlying asset is bought, then the investor can select the call option to sell. Typically, one call option could be sold for every 100 shares of the underlying. The key consideration when choosing the call options are the strike price and the expiry date. The strike price is usually above the current market price or out of the money and is a level at which the investor is comfortable to sell the underlying. The closer the current underlying price is to the strike of the call option, the higher the premium will be. This is because the probability of the covered call becoming in the money where the strike price is lower than the underlying price and being exercised at expiration is higher. The expiration date is based on the investor's time horizon and market outlook. Expiration dates can range from 1 day to several months out. The further out is the expiration date, the higher the premium for the option, as it has more time to become in the money. At expiration of the call option, there are several scenarios for exiting a covered call, depending on where the underlying price is relative to the strike. The covered call can be reestablished once the call option lapses. If the call option is out of the money and expired worthless, the investor can simply sell another call. If the call is in the money and the underlying is called away, the investor can easily set up the covered call again by purchasing the underlying and selling a new call option. Covered call writing is most effective in neutral to mildly bullish market environment. This strategy can enhance portfolio returns through the collection of premia and provide some downside protection. However, the strategy also limits the upside potential in a strong uptrend where the price of the underlying asset could rise significantly above the strike price. So in a strongly uptrending market, if the price of the underlying at expiration is above the strike price, such a call option is said to be in the money. In such situation, the call option seller needs to decide whether it wishes to sell the underlying or not. If the covered call writer does not want to be exercised, the call option can be rolled out to the next expiration period and potentially at a different strike price. Generally, rolling options forward involves allowing options to lapse or closing out an existing call option and simultaneously opening a new call option with a later expiration date and potentially a different strike price. And this technique could be used to avoid the sale of the asset when the original call option is approaching or is at expiration and the underlying price is above the strike price. If the call is not rolled over, the option would be exercised by the option buyer and the covered call writer has to sell the underlying at the predetermined strike price. In this case, the call option seller keeps the premium received and the gains from the rise of the underlying up to the strike price. Any movement above the strike price is basically forfeit. In a downtrend, if the underlying price has declined below the call strike price at expiration, the option will expire worthless, and the call writer would retain the underlying and keep the premium received from selling the call. Such a call option is said to be out of the money. The call seller would incur a loss in its shareholding position, which would be partially or fully offset by the premium received. If the underlying price has moved sideways and is the same as the strike price, such an option is said to be at the money. At the money options are rarely exercised by the buyer of the call. Therefore, the call writer has a good probability of retaining the underlying asset and keep the premium. The maximum profit potential from the strategy is if at expiration the price of the underlying is at or close to the strike price of the call option. The main benefit of a covered call strategy is the potential to generate additional income from selling call options and enhance the product's overall returns. If the underlying asset price remains below the strike price throughout the life of the option, the fund keeps both the premium and the underlying asset. The premium received from selling the call options effectively provides a downside protection against a moderate decline in the underlying asset price. The premium received also lowers the break-even point on the position and helps to reduce the portfolio volatility. In markets trading in a range to moderately bullish, covered calls can provide consistent returns from the premiums received. Selling options generally provides a higher probability of making a profit compared to buying options. When selling options, investors receive an upfront premium, which is retained if the options expire worthless. Buyers, on the other hand, the longer they hold an option, the more likely it is to lose value, making it harder for the option to increase in price and yield profit. The two main risks from covered calls are firstly the limited upside potential and secondly the obligation to sell the underlying. The maximum gains at expiration are limited to the strike price. If the price of the underlying is at the strike price, the covered call strategy reaches its peak profitability. However, if the underlying price increases significantly above the strike price, the covered call strategy would miss out on the full upside potential. So the maximum gain for the option seller, if the current price is above the strike price, is equal to the strike price minus the underlying asset price plus the premium received. If the price of the underlying asset is above the strike price at expiration, the covered call writer must sell the asset at the strike. The covered call writer could select a higher out-of-the-money strike price and preserve more of the stock upside potential for the duration of the strategy. However, the further out-of-the-money call would generate less premium income. So let's move on and discuss what the IncomeShares options 0DT ETPs are. The IncomeShares 0DT options ETPs seeks to generate consistent income for investors by selling daily 0 days to expiration put options on the S&P 500 or on the Nasdaq index. The ETPs use the premium collected from selling put options to pay monthly yield distributions to investors. The ETPs aim to realize enhanced income potential from the rapid time decay of these options and offer indirect upside exposure to the S&P 500 or the Nasdaq indices up to the option's strike price. The strategy's primary investment objective is to generate outsized monthly distributions by receiving a premium from selling in the money or at the money put options on a daily basis. It's important to note that the payoff characteristics of selling puts is the same of the buy and write strategy. However, put options premiums are generally higher than call options premiums, and in a rising market, writing puts has a higher probability of outperforming the covered call strategy. It should be noted that the ETPs do not invest directly in the S&P 500 or the Nasdaq indices. However, the secondary investment goal of this strategy is to gain exposure to the daily performance of the underlying indices up to the option's strike price. Days to expiration refers to the number of days remaining until an option contract expires. This metric indicates the total number of days between the initiation of a trade and its expiration date, and it's crucial in assessing an option's time value. 0 days to expiration options are contracts set to expire at the close of the current trading session, meaning they exist only throughout one trading day. These contracts are characterized by their rapid time decay and sensitivity to market movements. 0DT options are highly liquid with higher trading volumes and very tight bid-ask spreads. The primary difference between 0DT option and a regular weekly or monthly option is the significantly shorter time to expiration. In theory, the full range of options trading strategies could be applied to 0DT options despite the shorter time frame. However, the main strategies investors use to trade 0DT options include buying calls or puts to gain directional exposure and selling them to collect premium. Selling 0DT options is typically the most popular strategy, as any option that expires out of the money will be rendered worthless. With expiration occurring the same day, traders often favor this approach as the limited time frame increases the likelihood that the option will remain out of the money, making it a high probability strategy. By mid-2024, strategies involving 0DT options linked to the S&P 500 index have grown massively. This rapid growth followed the introduction of daily expiration trading for the S&P 500 and other major indices in 2022. Traders interestingly use zero-DTE options to speculate on intraday market movements, particularly through index ETFs like the SPDR S&P 500 ETF Trust, which offers zero-DTE options every trading day. The S&P 500 remains the most popular choice due to its high liquidity and the ability to trade options daily. In contrast, most individual stocks lack the same level of liquidity, which can result in poorer trade execution and greater slippage. So let's have a look at a hypothetical example showing how a covered call is established and how it performs in a bull, bear, and a sideways market. So on this slide, let's assume that investor buys 100 shares of NVIDIA at $110 per share. This means that the total investment in NVIDIA stocks is $11,000. The investor then chooses an out-of-the-money call option with a strike price of $115 expiring in 1 week. The premium that the investor can receive from selling that option is $2 per share. Since each option contract typically represents 100 shares, the total premium the investor would receive is $200. The net investment required would be $10,800, which is the $11,000 minus the premium received. So let's have a look at the potential outcomes. Let's assume that at expiration, NVIDIA share price rises to $113, but remains below the strike price of $115. In this case, the call option expires worthless and the investor keeps the $200 premium received upfront. The investor still owns the $100 NVIDIA shares, which now would be worth $11,300. The total proceeds from the strategy are the current value of the shares plus the premium received, which means that the investor will receive $11,500. The total profit from the strategy is $500 itself. We just take the current value of the shares minus the purchase price of the shares plus the premium received. Let's have a look at another scenario. If at expiration, NVIDIA share price rises to $117 and is well above the strike price of $115. The call option then would be exercised by the option buyer. However, the investor would keep the $200 premium that it has received upfront. The investor would have to sell the 100 NVIDIA shares at the strike price of $115 and receive $11,500. The total proceedings from this strategy would be $11,700 because we add the premium received. The total profit from this strategy would be $700 as we calculate the sale price of the shares minus the purchase price of the shares plus the premium received. And let's have another look if at expiration NVIDIA share price actually declines to $108 and it's well below the strike price. In that case, the call option would expire worthless and the investor can keep the 200 premiums received. The value of NVIDIA shares would be lower at 10,800 given that NVIDIA price declined. However, the total proceeds from the strategy would be 11,000 because we add the $200 premium received. The total profit from the strategy would be zero. So it means the investor is not losing money despite the decline of the share price of NVIDIA. And now I want to show you a couple of slides Let's have a look at the actual performance of IncomeShares Tesla ETP since inception. In this chart, we compare the performance of Tesla share price, marked in red, IncomeShares Tesla ETP, total return, marked in gray, and the NAV performance of Tesla in white. We can see that the total return Tesla ETP have outperformed the share price of Tesla, and this is because throughout August and September, Tesla traded mostly in a trading range. Most probably your broker would show you a chart of the NAV of the fund show in white, which is shown in white in here. But you have to be careful because this is not a representation of the performance of the Tesla ETP. We have to incorporate the monthly dividends that the fund distributes, which is the gray line here. And let's have a look at another example of NVIDIA. We have a similar graph. The NVIDIA ETP fund performance since inception is marked in gray. NVIDIA share price is marked in green, and the NAV performance is marked in white. Here we see that the NVIDIA ETP slightly underperformed the price of NVIDIA just because NVIDIA took off. And if you recall, the covered call strategy caps the upside potential up to the strike price. That's why the fund is, the total return fund is slightly underperforming. However, if we get to see a pullback in NVIDIA share price anytime from now on, most probably the total return NVIDIA fund would outperform the price. And now I would like to pass back to Oktayka Brak to pass through some of our income products. Thank you.
Okay, so before we just move to the Q&A session, I just want to go over the current range of IncomeShares ETPs currently on offer. So I just want to go over to the, yes, we're on the correct slide. So as you can see, we currently have 11 ETPs that are divided into single stocks, one commodity, and two indices on the S&P 500 and NASDAQ 100. What you'll also notice is that there are two strategy types. So for all of the ones that are tracking an individual security, it's a covered call strategy. And for the two index products, it is a cash secured put strategy. We are planning on expanding the range up until the end of the year, and I think you can expect that we will also be adding new asset classes over the next few months. All right, so with that, I think we can go into our question section to see if you have any questions after Violeta's presentation. Okay, so I think I already see a few here. So I'm going to, leave these for Violeta, and then maybe I can also add some color to each of the questions. So the first one that I see is, when will these ETPs be listed in the US markets? I think I can handle that one directly, Violeta, if you don't mind. So leverage shares ETPs, which are domiciled in Ireland, are currently not available for US investors. We do have a sister company that does offer ETFs in the US, but that is not under the European leverage shares umbrella for now. So these current IncomeShares branded ETPs will not be available in the US. That's the short answer. The next question I see is, what is the strategy for preventing NAV erosion on the zero DT products? So maybe I can try to answer that one briefly on my end, Violeta, before I pass it over to you. So I think the important thing here is to remember that the primary objective of these products is high income. So obviously there's a few ways that you can treat the income that the fund receives through the option premiums collected. And with the zero DT products, you have to keep in mind that it's the extrinsic value that we're collecting. So if we were to pay out a lower amount compared to what we collect, obviously that would mean a lower erosion in the NAV. And another way of doing it would be just to pay out distributions more frequently because they would have a lower impact in terms of the NAV decline every time there's a distribution. So, of course, these are certain factors that we're going to be tracking and observing very closely, especially as these products build up a track record. But I think what you'll notice, especially since inception, which has only been a month or so for these products, they've been holding up relatively well. But it's a good question, and it's definitely something that we will be paying very close attention to moving forward. I also see a raised hand. I don't know. Okay, so and just because we're running out of time, I think I will go through maybe 2 more questions, and then I think we have probably another 8 or so to go. So we will reach out to you individually via email if that's not a problem. So apologies for that, but we are really running low on time. So the next question I see here is, will there be new ETPs on indexes, Russell, stocks, commodities, bonds, treasury? I think I slightly alluded to this a little bit earlier, but the short answer is yes. So I can't confirm that all of these will be available, but we are definitely looking into adding not only other asset classes, but adding to our existing pipeline of not only index-based products, but also commodities and others. So yes, stay tuned because we expect the IncomeShares brand to grow to a product base of over 20 quite soon. And then one other question. So this one, which brokers currently offer access to the IncomeShares ETPs? I think the best resource here is basically the IncomeShares website. But just a few off the top of my head, of course, Interactive Brokers, Trading 212 currently have these on offer. Hargreaves Lansdowne has a few of them already, but yeah, as I mentioned, you can see the full comprehensive list on our website. And maybe I will keep this as the last question because I'm getting word that we probably have to wrap things up. Can we expect additional listings on other European exchanges? The answer once again is yes, and very soon. So probably in under a month, we will have these in additional currencies and on other European exchanges. So please make sure to stay tuned, subscribe to the newsletter, and you can always visit our website for the most recent updates compared to our products. Okay, and then just moving over to the last slide. Oops. Once again, thank you everyone for your time today, your participation. Of course, if you'd like to learn more about our IncomeShares range or access more detailed information, you can visit our website, which is IncomeShares.com. And you can also reach out to us via email, currently info@leverageshares.com. And we will try to answer all the questions that you have. Thanks again, and have a great rest of the day.
Thank you, everybody.